Okay, so the bank approved you for $900,000 and your life is about to change. Maybe you're going to have a baby or a career switch or a maternity leave, and suddenly that mortgage that seemed affordable isn't. So let me be specific because life change is two-way. Number one, mat leave or parental leave covered above. One income temporarily drops to 40 to 50%. There's another example where you can get either a job loss or layoff, more common than people actually admit. And even 6 months of EI at 55% is brutal on a maxed mortgage. Then there's the career switch. Maybe you're leaving a corporate to start a business or going for an employed to self employed. Lenders want 2 years of self employed income history before they even touch your refinances. That's 2 years of potential cash flow strain. Then, often the most overlooked things is health issues. Unexpected, but it happens. Disability coverage often kicks in at about 60 to 70% of the income. And relationship change, I'll leave that one there. Any one of these events, while carrying a mortgage at 98% of your approval limit, turns a manageable situation into a genuinely dangerous one. So here's what I tell every first time homeowner who sits down with me is like, let's build a 20% buffer before your maximum approval. If the bank approves you for 950,000, you should search. Your search should start at 760, not because you can't afford more on paper, because life doesn't run on paper. I can give you my personal example. When I was looking to buy a house, I was approved for 1.3 million, but I myself bought a townhouse for 650,000. That just shows that when the interest rates went up, I wasn't really affected. Like, yes, my mortgage payment went up, but it was manageable, right? And in Surrey, for a $760,000 number gets you into solid two-bedroom condo, or now even a townhouse, depending where you're looking at. It's it's not the home you dream about, but it's a home that doesn't ruin you if one of these things changes. You can always move up in 3 to 5 years when your income is established and your family's plan and your equity has started building. You cannot easily climb down from payments that you can no longer afford. And one more thing, and this connects back to episode 3. When you're buying at the top of your budget, you're also draining your savings from the down payment, which means no emergency fund. If you've been using your FHSA up to 8,000K a year to $40,000 in lifetime, and your RSP home buyers plan up to $60,000 per person, those funds are gone into the purchase. There's nothing left for 6 months where mat leave heads and the furnace decides to give out simultaneously. The move is simple. Even if it's hard, but slightly below your max, keep 3 to 6 months of ownership costs in cash. That's your actual safety net, not the approval letter. Hey, welcome back, everyone. So, we started this series talking about the gap between what the bank approves you for and what you can actually afford. We covered the true costs of owning a home beyond the mortgage. We talked about why draining your saving for a down payment is a trap. We ran the rent versus buy myth, and we broke down how interest rates quietly reshape your real purchase price. So, 6 episodes, one goal, help you buy a home you can actually live in without it owing you back. This is the final, and I've saved the most emotionally loaded mistake for the last. So, buying at an absolute top of your budget right before a major life change. I've seen this happen more times than I can count. A couple qualifies for $950,000. They find a townhouse in Clayton they love, and it's listed at 940. Okay, we can make it work, they say. 6 months later, one of them is on a maternity leave. The income drops by 40%. That mortgage payment that was right at full salary is now a crisis. Not because they made a bad decision emotionally, because they made a math mistake at the worst possible moment. Let's put the real numbers on this. Like a $940,000 townhouse in Surrey or Fleetwood with 10% down is at 846,000. And at today's rate, let's call it 4.5% at a 5-year fixed amortization for 25 years, your monthly payment is about $4,650. Let's add another strata, that's $350 a month. Property taxes in Surrey is about $3.50 for every $1,000 assessed. So on a property of $940,000, let's say it's about $275 a month. Insurance, utilities, maintenance, reserves, that's another 4,000. So by the end of the month, you're looking at about $5,675 in real ownership costs. Now, what does mat leave actually pay? At least um, in EI, the maternity benefits replace about 55% of insurables earnings, uh, up to a maximum in 2026 is about uh, $34,000 a year. Now that's about 2,800 a month before taxes. If your household was running on two salaries, say a combined of 140,000, one salary drops from 70 to 34, you just lost $3,000 in take home, and your ownership cost does not move a dollar. That's not a budget estimate, that's a financial emergency. Now, here's what makes this particularly frustrating. The federal stress test, which we talked about in episode 5, was specifically designed to protect you from this, and you have to qualify at a contract rate of plus 2%. The banks will tell you you pass the stress test, you're fine, but the stress model uh, are like based on the interest rate risk. It does not include the model where it does not model your income risk. Okay, so it has no idea you're planning to start a family. It does not know you want to go back to school. It does not account for your career pivot you've been thinking about for past 2 years. The stress test is a regulatory tool. It's not a life plan. So, this is the end of the first series we did. The 6 episodes. Here's what we covered. Number one, bank approval aren't the same as what you can afford. Two, the true cost of ownership go way beyond your mortgage. Episode 3, we covered how draining your savings for down payment is a trap. And in episode 4, we had rent versus buy math for more nuanced approach that you've been told. In episode 5, you had interest rate changes, how they affect your purchases very quietly. And episode 6, this one, how life changes don't care about your approval letter. If you're just finding out about this series now, I would suggest go back and watch episode 1. The whole thing is designed to be watched in order. The goal was never to scare you away from buying. The goal was to make sure that when you do buy, you actually stay in that house, because a home should feel like a foundation and not like a trap where you can't get out.